Hello, how are you? Today I'm going to do none other than the Walt Disney Company, the stock valuations in the series. The ticker name is DIS and the company is Disney. In this series, I use the model and compute the intrinsic value of the stocks. The reason I have did the Disney earlier as well, the stock analysis in the series, but in that one I haven't computed the intrinsic value. So now when the park is opening, the economy is opening. So I thought, well, let's review this stock again and see if it's a good buy or not, right? So without any further delay, let's get started. So in today's agenda, I have this is my agenda. I'll go over the Disney company overview again, just to refresh the memory. What is this? Give you some alarming fact. In my earlier video, when I did it like a 2 months or more ago, I have very deep dive into the companies and what basically it does. And then we'll go to the top level returns and see how the company is doing in terms of its liquidity, how often the company do the repurchase and the issuance. And then I use the two models in this one, the net profit model and the enterprise value model, to come up with the intrinsic value. I also show you why I haven't used this time the free cash flow model as well. And then we can see if it's a good buy or not a buy, right? So without any further delay, let's get started. Let me put myself away so I won't block anything. Okay, so the Disney company basically, it has a main four business segment. It's always good to know what the business is all about before we jump and dive into it. So mostly people are familiar with the Disney park, who has the kids or they went into their right, but they also, or maybe the cruise line, resort and theme park, but they also have the shares in ESPN and National Geographical channels and so on, right? They make the video studio entertainment, and they have like a Disney Plus which they have introduced, and also a certain share in the Hulu. As per September 2019, this many people, 223,000 people were employed by Disney, and soon after September is coming next month, and they should have this yearly review as well. Okay, so so in 19 they acquired the 21st Century Fox Inc. There's some fact about it, and rename it TFCF, right? Disney Plus is launched, and we have seen in the news they get some share from other streaming service providers. Now their Hulu, who is also doing the similar kind of a Netflix kind of a services now, which boost their stakes to 60%. So 60% of the shares or the company controlled by the Disney. 30% owner in the Tata Sky, which is a big name in India. Wise Group is 21%. Wise Group does the documentary and all, and this is the entertainment side, which is a big name. You can search it. I won't go into deep. I already did in my last video, is a 50% stake. So that's a pretty much high level. So it's a very broad-based entertainment kind of a company who has a theme park and direct streaming service and all. So that's on it. So let's see from the return perspective. From the return side, I have taken from 2010 to 2019 annual return, and you see I have return on investment capital, which is in the blue line, and then return on equity is on the orange, and then the gray is return on assets. So if I come on our investment, if we invest in Disney, it's going very nicely until 2019, right, which is dropped to 8 points some percent, and I believe this year is even worse, right? So started from 7 and then range started to 20s and higher, right? So overall, but recently it's start dropping. Okay, but overall is a double digit, is okay. The company is good. Let's check on the liquidity side. The liquidity side, if I see the company is again for a 10-year plot, anything above 1 is good. So the current ratio is right now is below 1. And I have raised in the past as well. That's one of the main problem with these kind of heavy fixed assets company, right? Because they need to flush a lot of cash to keep them running, right? If they not, then they suffer. So that's the main problem there. Okay, so if you're new, yeah, so if you like so far, and now I will also go into the models, so please give a thumbs up, whether you're new or old subscriber. It really motivates me to make this video, and subscribe as well, if you are new to the channel. Okay, so this one is quite interesting. That's why I take this picture here. So basically what it's trying to say is how many in from 2012 to 2020, how the Disney is doing in terms of the share repurchase or issuance. So it seems like is they whenever it's dipped, they went down, and basically it's to often go the purchase of the share, and then it goes up to issuance of the shares, right? So you can see here it's going quite up and down, up and down, and up and down, right? So, and these are on the quarterly basis. Oops, not now. So yeah, so let me go to the model now, and I'll share the to the spread. I open the spreadsheet so you can see we can go over the pricing. So prior I'd go to the model, which is, you can see, is net profit and price and other models. I just want to highlight, right, to see from the 10-year perspective that what's driving their return on equity, right? So this is a very good model to see the overall, what's going on with the company, what is driving the bottom line and all, right? So let's see. So return on equity, basically if I see the this is again the 10-year of the data, the bottom line, the profit margin is from it's increasing, right, from 10.41 basis points to, then it goes all the way to 16, and then it come back again to the 10 points. So right now it's over a little bit over their 10-year average. So if I see from the operating profit side, again this is a little bit less than as compared to the 10-year average, right? But it's overall it's double digit is good. The retention rate is also good. The company is not paying too much of the taxes, it's retaining above its average. The asset turnovers, basically how good the company is able to generate revenue based on the assets. So now since 2019, in the last year, right, on the annual statement it's not doing that great. It's way less than its historical average. On the financial leverage side, this seems okay until so far, but yeah, so it's 1.99. So if you can see, so basically it's saying the assets over equity, so they don't come. So basically bottom, what it's trying to say is the company has some debts, but it's not that bad, right? So it's okay as compared to the historical. But if I compare with this historically, its 10-year average is over. They're now started, since seems like for 5 years they have more debt as compared to the previous first 5 years, right? So which is not okay. So that's hopefully you enjoyed this as well. So let me go myself on height, so I won't interrupt on the model, right? So sometime I forget. Okay, so here I'm showing you the net profit model. As usual, I have taken the 10-year of the data, and here is the 10-year of revenue, 10-year of net profit. And what this nice matrix is saying that the year over year growth on the 10-year is, for the last 10 years, is 6.22%, right? So which is quite good for this heavy assets kind of company. But one good thing about this is way much better is in the 10-year. If I see the net profit, the net profit grows around almost 11% perspective year over year, which is way good. And here I haven't fully so we'll see more on this year or year end and next year end, right? How the Disney Plus streaming services, right, which is their own brand, how they are doing, how they are in terms of the collecting revenue. But if I see from the recent 5 years, right, mostly when I went into their 10K, they mostly do this growth by the acquisitions, right? As you also have noticed in the first deck, whether they have go there and buy the companies, maybe the buying the growth, but maybe that's but still, as compared to the first 5 years, their profit margin is almost half, right? It's 5.6, almost like half of like 11 or 5.69 almost, right? So anyway, so what I have done here, I project the 10-year overall. That's how the model works. I project the 10-year of the net profit, and then I have discounted by the 10% rate, right? So for me, if I'm not getting my 10%, I rather invest in S&P 500, right? And for the term and the net profit growth rate, I have taken the 8.25, which is less than the 10-year, just to be conservative, right? And the long term, I take it 2 years. So you have noticed my growth rate is declined from 8.25 to 7.55. So if I see how much is declined, so basically this minus this, right? So it's declined by almost 69 basis point consistently, right? I'm declining. It's just I use the interpolation, but that's how the decline rate is. And on the 10-year, I assume the company, I'll sell it as 22 of the PE, which is way less than its current and industrial PE, right? I just want to be conservative, and at the same time, I think the company's and right now the PE is way over value as compared, right? So it doesn't look good. 48 is too much. Okay, so if I see, so I have grown the company, taken the PV, and then my market cap is coming around $247 billion, right? Right now the share outstanding is 1.18 billion, 1.8 billion shares. And if I divide this number by this number of shares, I will get $136.78 as my price, right? So that's how I'm getting it. Let's go to the next model. So for the next model, the next model which I have taken here is the enterprise value model. So here you can see this is the enterprise value in September 2010, and then it grows to 273, right? And if you can see the operating EBITDA, which is the operating income plus interest plus tax, prior to interest, tax, and depreciations, which is very easy to compute, but just to save time, I have put it here. So if I divide these two ratio, it goes, so basically the EBITDA has grown from 11.11 to 14. It's still under 15. So don't think from that ratio, if every time it goes higher, it's good, right? We don't have to think from that perspective. So for example, usually the enterprise EBITDA, so how this is looking, right? If my enterprise value, for example, it's growing, right, and consistent going at almost 11% rate for the recent 5 year, right, which is very good. But at the same time, my operating income is declining, right? So that's why this is increased. So which is not a good sign, right? So which is considered as a bad. So I consider it as a bad, right? So for me, if it's going over 10, I really honestly don't like it. So because the main reason here is, if you can see, it was around 11 and then it goes to 8 and 10, but with the recent past, because of the operating income is only generating at 3.25, so that's the reason this goes up, and which is not a good sign. This means if you buy the company as a whole, it will take almost like a 14 years rather than 8 or 10 years for the company to generate that much of the cash flow. On the similar side, the debt is 2.43, which is a way higher as compared to how much company is generating the cash flow, right? If I compare that with the previous 10 years. Similarly, you can easily see how the debt is growing with it's almost over 22% for the recent past, which is not a good sign as well. Anyway, so for me, I have taken the little bit conservative approach and 5.73 as the EBITDA growth rate, and I grow and then I decline that growth rate to 2%, right? Almost like 50 basis points. I'm declining almost, and then once I project it, then I basically uh, uh, assume that I'll sell the company by 12.3770 times of its 10-year EBITDA, right? And basically, and then use the same 10% discount rate to come up with the present value. So by summing all, taking consider of the average debts and the average cash, I got $267 billion, right? And the number of share outstanding this once, and the second model give me $147.71. Okay, so I do have basically, I just need to put the number. I have the free cash flow model as well. The problem is, and I haven't used this model for this time, is because the free cash flow, when I compute this, the free cash flow for the 10-year and 30-year is all coming negative. So company is not able to have good free cash flow. So therefore I disregard this, right? So if you can easily see the free cash flow for the just discard this, right? Because I haven't used this, so I'll hide this. So for 4 billion, and then now it's 1 billion, right? So it's even negative. So that's the reason I don't use this. Okay, the final price, basically now I have only two model, which is good, as well as a stable company net profit model and enterprise value model. So one is coming from me, I gave equal weight to both, and then my price is coming as $142.25. If I see what's in the market right now, the share is price is $130. So right now, as per this model, the value is on the discount, right? So the price is undervalued at the moment. I believe once the streaming service, they are making the good money on the streaming service and other, but once people are going into the park, or they're already going and fully, it will do well, right? So that's on my side on this one, and I just kindly thank you for your time to be with me and analyze this. Give this video a like and thumbs up. I really appreciate your subscriptions, your comments in this video. If you want me to analyze, for sure put in the comments any other ticker. I will love to go and do this kind of a video for you. Okay, so thank you and see you soon in new video. Bye for now.